You're standing in the cereal aisle. It's a Tuesday around 6:47 in the evening. You've got maybe 12 things in the cart and you're doing the math in your head, the way you always do, trying to figure out if this is the trip where you have to put something back. You don't check your bank account. You already know it's close. You just don't want to see it. So you grab the cereal, the name brand one, because it's $2 more, and that somehow feels like the one thing today you're allowed to control. You get to the register, swipe the card, wait, approved, you exhale, load the bags into the car, drive home, and somewhere between the parking lot and the front door, you stop thinking about it. That's the system working exactly as designed. You grew up in a house where money was either there or it wasn't. Nobody sat you down and explained it. Not really. You heard things: work hard, save up, don't spend what you don't have. Broad strokes. Bumper sticker advice. School didn't help either. You learned the mitochondria is the powerhouse of the cell. You learned the quadratic formula. You learned the causes of World War I. Nobody taught you what APR meant. Nobody explained what happens when you only pay the minimum on a credit card. Nobody walked you through a pay stub and showed you where the money actually goes before it hits your account. So you learned by doing, which is a polite way of saying you learned by getting it wrong. You got your first job, maybe 16, 17 years old. They handed you a check and you felt like you had money for the first time in your life. You spent it quickly because that's what it felt like you were supposed to do with it. You didn't know what a W-4 was. You just signed where they told you to sign. You didn't know what FISA was. You just noticed the number on the check was smaller than you expected. You told yourself you'd figure it out later. Most people do. And most people are still figuring it out at 35, 40, 50. Not because they're careless, not because they're irresponsible, because nobody showed them. The first credit card comes easier than you expected. You're maybe 20, 21. You fill out a form online. A few days later, a card shows up in the mail with a $500 limit, then $1,000, then $2,500 as you prove you can make the minimum payment. The minimum payment, that phrase does a lot of quiet damage. Let's say you carry a $2,000 balance on a card with a 24% interest rate. The minimum payment might be around $40 a month. That sounds manageable. That's less than a streaming subscription and a fast food trip. What they don't tell you, at least not in a way that lands, is that at $40 a month, it takes you over 7 years to pay that off. And by the time you do, you've paid almost $1,500 in interest alone. You borrowed $2,000. You paid back $3,500. But the statement doesn't frame it that way. The statement says, minimum payment due, $40. And $40 sounds fine. $40 is fine, so you pay $40 and move on with your week. Around the same time, your rent goes up, not dramatically, maybe $75 a month. Your landlord sends a letter in February saying the new rate starts in April. You absorb it, adjust, cancel something small, maybe that gym membership you weren't using anyway. You pick up an extra shift, or you just charge a little more. The card is there. That's what it's for. Your bank account has $340 in it on the 27th of the month. Rent hits on the 1st. You know the math. You've done it so many times. It's automatic now. You're not worried. You're just operating in a narrow lane. And it feels normal because for most of your adult life, it has been normal, and something breaks. Not metaphorically. Something actually breaks. The car, a tooth, the water heater. It doesn't matter which one. Pick the one that happened to you, because they all lead to the same place. A bill arrives that your budget cannot absorb. $800, $1,200, $2,400. You don't have it in savings because you never quite built savings. There was always something: rent, groceries, the electric bill that spiked in January, the copay you weren't expecting, the registration fee you forgot was due. So you put it on the card, and now your balance is higher, your minimum payment is higher, your available credit is lower. Your credit utilization, the percentage of your available credit that you're using, just went up. That number matters more than most people realize. Lenders look at it. If your utilization goes above 30%, your credit score starts to drop. Your credit score is a number between 300 and 850. It controls more of your life than almost anything else, and nobody told you that clearly when you were young enough to build it carefully. A score under 670 and your car loan has a higher interest rate, under 620, and apartments start requiring double deposits, under 580, and certain jobs, finance, government, some healthcare roles, may flag your application. You're not in catastrophic territory yet, but you're drifting. Each month, the balance doesn't fully clear. Each month, the interest compounds. Compound interest is one of those concepts that sounds mechanical and distant until it's working against you, and then it's personal. Your paycheck comes in. Rent, car payment, insurance, utilities, minimum payments on 2 cards now, groceries, gas. By the time you've covered the fixed costs, there's maybe $180 left for 2 weeks. Not to save, not to invest, just to exist. And you tell yourself, when things settle down, I'll get ahead of it. Things don't settle down. They rarely do. Here's what nobody explained when you were starting out. The system you're living inside wasn't designed to be transparent. It was designed to be used. And the people who know how to use it are the ones who were taught by parents, by advisors, by inherited knowledge that moves quietly through certain families and not others. They knew to max out a Roth IRA at 22. They knew the difference between a 401k match and a pension. They knew that paying points on a mortgage up front can save tens of thousands over 30 years. They knew that a high-yield savings account exists and that a basic checking account earns you almost nothing. You didn't know those things, not because you weren't smart enough, but because that information wasn't handed to you. There are entire industries built around the gap between what people know and what they don't. Payday lenders charge effective interest rates above 300%. They're legal in 27 states. Their storefronts are concentrated in zip codes where incomes are lower and financial education is thinner. Overdraft fees generate billions in revenue every year, paid almost entirely by people who are already running low. Car dealerships advertise monthly payment amounts, not total cost, not interest rate. Monthly payment, because $399 a month sounds manageable. The $9,000 you'll pay in interest over the life of the loan is mentioned in the paperwork you sign in a fluorescent lit room after 3 hours of back and forth. These aren't coincidences. They are structural features, and when you don't know they exist, you move through them as if the terrain is flat. You don't see the grade until you've been climbing for years, and your legs are already tired. The moment usually doesn't announce itself. It arrives on a Wednesday or a random Saturday morning when you sit down to actually look at the numbers, really look at them for the first time in months. You open the accounts, all of them, checking, $214, savings, $0. You pulled from it in October and never put it back. Credit card 1, $3,400 balance, minimum payment, $68. Credit card 2, $1,800 balance, minimum payment, $46. Medical bill and collections, $620. You didn't know that could happen. You thought you were just behind on it. You didn't know behind had a deadline. Student loan, still there. Deferred technically, but the interest kept accumulating during the deferment. The balance is now higher Then when you graduated, you added up, the total debt number stares back at you. And for a moment, everything goes quiet. Not dramatic, not like a movie, just quiet. You think about how hard you've worked, how many shifts, how many hours, how carefully you've managed each individual crisis as it appeared, and how none of the effort, Charinalis, changed the shape of the whole, because effort alone doesn't change the structure. And nobody told you that. They said work hard, they said be responsible. They did not say, here is how interest compounds, here is what a credit utilization ratio is. Here is why a Roth IRA is different from a traditional one and why it matters which one you pick at 23. Here's what actually happens when a debt goes to collections. Here's the difference between term life and whole life insurance and why one of them is mostly a product being sold to you. They didn't say any of that. And so you worked hard inside a structure you didn't understand and called the results your own fault. You close the laptop, you go back to your day, because that's what you do. That's what most people do. But something has shifted, not dramatically, just slightly. The way a room feels different after you've moved the furniture. Even if everything is technically back where it was, you start noticing things. You notice that your coworker, the one who seems to float through financial stress without sinking, grew up in a house where her dad was an accountant. She knew what a W-2 was at 14. She opened a Roth IRA at 20. Not because she was more disciplined, because someone explained it to her before she needed it. You notice that the news talks about the economy in terms that assume a baseline of knowledge you were never given. Inflation rate, Federal Reserve, prime rate, yield curve. These are the rules of a game being described to an audience that was never taught how to play. You notice that the advice, save more, spend less, invest early, lands differently when you understand what it actually means to invest. When you know the difference between putting $200 into a savings account versus putting $200 into an index fund for 30 years, those are not the same thing. One of them earns you maybe $12 a year. The other one, over 30 years at a historical average return, turns $200 a month into something close to $240,000. Same $200. Completely different outcome. Not because of discipline, because of knowledge and access to that knowledge and the timing of when you received it. You think about the cereal, the name brand one, the $2 extra. You think about how many small decisions you've made inside a system you were navigating blind. How many times you chose the thing that felt like control when you didn't have much else to hold on to. You don't hate yourself for it. You just understand it now in a way you didn't before. The question you're left with, the one that doesn't have a clean answer, is what you do with a map when you're already deep inside the territory, and what it means that some people got the map before they left the house and some people didn't.